Well, hello there. Welcome to Chapter 15 for Business Math, Building Wealth Through Investments. So when you think of investments, you may think of stocks, bonds, mutual funds. And if you did, that is actually what we're going to be talking about today. So hang on tight. If you're wanting to know more about stocks, bonds, and mutual funds and what we cover, I would advise meeting with a financial advisor because they can walk you through how to invest. I'm not going to show you how to invest or give you advice on where to invest. We're going to focus more on the math behind it, but this would definitely be a good time to start investing if you're thinking about it. So you may have heard of Warren Buffett. He is wealthy. He's actually number 2 on the rich list, $75.6 billion, just behind Bill Gates. And this may have changed since I wrote this, but he is worth quite a bit of money. And his money actually comes from doing things like buying stocks. And it happened when he started this, he was 11 years old. And then when he was a teenager, he owned multiple pinball machines, and then he invested in a farm. So it was all about investments. And if you wanted to check out this YouTube link, it will show you a couple who invested in Apple stock back in the day, and now they have made quite a bit of money just because they invested so early. So there is potential to make a lot of money through investments. There's also potential to lose money, but that's a risk you have to take. So how the stock market works, or the market in general, there are private and public companies. Private companies would be entrepreneurs, partnerships, sole proprietors that decide to incorporate, whereas public would be larger companies that often want to grow quickly. So what they'll do is they'll sell some of their shares to the public, and they do that through a format known as the stock exchange. So there's these different kinds of stock exchange. There's a New York Stock Exchange, American Stock Exchange, and that's a lot of words. So you've probably heard of these. So let's say we want to start a business, and we want to start this business selling cupcakes. Well, where do you get the money from? You can hit up your friends, you can sell your own items to try and make money. But another option is that you can open it up for people to buy stock in your company, so then they have part ownership, but you have money to start the company that you want. So investing is just purchasing a financial product or other item of value with an expectation of favorable return. So obviously you're hoping that you'll get some money back, and you're hoping to get 10 times more or 5 times more. You're hoping to get significantly more than what you invest. The purpose of investing is to save money in order to improve financial well-being, to kind of set yourself up for a good future. One of the ways you can invest is through stocks. Stocks are instruments that signify ownership in a corporation and represent claim on a share of a corporation's assets and profits. So if the company profits, you profit. If the company loses money, you might lose money. Stocks are typically riskier than mutual funds or bonds, and they're usually more long-term investments. So the riskier the investment, the greater the potential for return, but also the greater the potential to lose all your money. So stocks are a little bit riskier. Bonds, on the other hand, those are interest-bearing certificates used as a way for government or business to raise money. So you may have heard of government bonds. The bond holder, so the person in charge of the bond, basically lends the money to the bond issuer for a set amount of time and interest. When the bonds are sold back to the issuer, the interest earned is given to the bondholder. The bondholder would be you. Bonds are typically low risk, so not as risky as stocks, and they're pretty good for short-term investments if you only want to leave it in for a couple years or so. So in other words, to raise money, governments, government agencies, municipalities, corporations can sell bonds. And when you, as the consumer, buy the bond, you're essentially lending money to this entity for the promise of repayment, in addition to a specified annual return. So you're loaning them the money, but expecting to get repaid. In that sense, a bond is really nothing more than an IOU. Mutual funds? Those are open-ended investments that are professionally managed and consist of a variety of investment instruments, including stocks, bonds, options, commodities, and money market securities. So within a mutual fund, there could be stocks and bonds. And it's made up of multiple different stocks and bonds because it allows you to diversify. And if you diversify your assets, then it's going to give you greater safety and reduce the risk. Because if one of these stocks goes down, you haven't lost all your money. You still have investments in other areas. So it's kind of like not putting all of your eggs in one basket. You're putting it in multiple baskets so that there's more safety. You don't have to worry as much about that one stock you invested in crashing. And they're more long-term investments, so you wouldn't want to just put it in for a couple of years. Okay, so some different key terms. The distribution of ownership of a corporation. Partial ownership can be purchased in various stock markets. That's just a stock. If you own one unit of a corporation, that would be a share. The value of one share of stock would be the face value or par value. Certificate of ownership is the stock certificate. The portion of the profit of a company that is periodically distributed to the stockholders of a company would be the dividend. So that's what you get paid out, is the dividend, the amount that you get. Okay, there are different kinds of stocks. There's the preferred stock and the common stock. Preferred stock is a type that guarantees a specific dividend to the stockholder. And the preferred stockholder does not have voting rights. So you're definitely going to get a dividend, though. You're guaranteed that. But you don't have any say. Common stock, however, you do have voting rights. So you do have some say. And you have to wait until dividends are paid to preferred stockholders before they get distributed to you. So they're lower priority, even though they do have voting rights, and they're not guaranteed a dividend if the money makes money, but the preferred is. So preferred, guaranteed dividend, common stock not. You have to wait until preferred stockholders are paid, and then you get the money. Okay, the stock market is just a structure for buying and selling stock. When you buy and sell, you're trading. The stockbroker is the person who handles the trading, kind of in charge, and they get a commission for doing so. If you want to find information about the stocks, look in the stock listings. Price to earning ratio, which we call the PE ratio, you'll see this come up time and time again, is the ratio of the closing price of a share of stock. So the closing price, usually the day, when the day ends, it's what the share of the stock was worth compared to the annual earnings per share. All right, so here's an example of a stock listing. Now if you have an iPhone, or I believe I'm only familiar with the iPhone's stock listings because that's what I have, but if you have another phone, I'm sure there's some sort of stock app that may be built in already. And it won't look exactly like this, but it'll have this information listed. So let me show you. I think I have, well, I'll show you an example in a moment. I think I have that on here of what it looks like on your phone. But you'll notice here are the names of the different companies. This is the New York Stock Exchange. And then you have all of these different categories. So the stock prices are listed in dollars and cents, so you'll see it always rounded to 2 decimal places. Positive and negative signs will show the direction of the stock. So if it's increasing, it'll be positive. If it's decreasing, it'll be negative. Sometimes you'll see it in green and red. If it's positive, it's green. Negative, it's red. So 0.13 would mean that the stock went up 13 cents from the previous day. Negative 0.03 means it went down 3 cents from the previous day. Okay, so column 1 shows the corporation name. There's oftentimes each one will have a symbol associated with it, which you'll see in column 2. And it may not be what you think it is, like AT&T, you might think it's ATT, but no, it's just T. And that's oftentimes because maybe that name was already being used. Column 3 is the opening price. So when the stock market opens that morning, this is the price per share. So for AT&T, it's $26.24. 4, 5, and 6 will show you the high, low, and closing price for the stock on that given day. So this was the high, this was the low, this was what it ended up closing at. So it's 4 cents above what it started at. And it went up and down throughout the day. Now, typically you won't see it go up and down that much. Okay, column 7 is the day's closing price per share, how it differs from the previous day. So if you notice, it was at closing, oops, where'd it go? Okay, so this had gone up 22 cents from yesterday. So since it's positive, that means it had gone up 22 cents. And this is the percent at which it went up or down. So it went up 0.84%. Number 9, this is the volume, which means the total number of shares that were traded that day for that particular stock. So there were, wow, quite a few, 23,382,357 shares sold that day. Notice these are 52 weeks, so 52 weeks in a year. This is the yearly high and the yearly low. So in the last year, year to date, not starting in January, so 52 weeks from now. So a year ago, this is what the highest that it's reached and the lowest that it's reached. So it's been a little higher than it is today. 12 is the dividend paid. So remember, that's what they pay out to the stockholders per share of stock the previous year. Now you'll notice that next to this one, some of them you'll notice there's a little slash, so they must not have paid out a dividend. You'll also notice an E next to some of these. That means it was an irregular cash dividend. So that means they made an extra payment or one that was not regularly scheduled. Yield is the previous year's dividend as a percent of the current price per share. So in this case, it's 6.4. So these are all percents. So 6.4% is the dividend. Now, if it had a slash here, it's going to have a slash there because it was 0% basically. Okay, the PE ratio, which I mentioned earlier, price to earnings ratio, is 13 on this one. So what they use them for, investors and analysts often use these to determine relatively what the value of the company's shares are in comparison to other shares. Sometimes they'll use it to compare against another company or against its own historical record, things like that. So it's used for comparison purposes more than anything. And then 15 is the year-to-date. So no, it's percentage by which the closing price differs from the first business day of the year. So for probably in the beginning of January, from then to now, overall what it's done, since it's red and negative, it's gone down 6.2% in the last however many months it's been since the beginning of the year. Okay, so here's the picture I was looking for earlier. This is a picture from, the iPhone app, and it may look similar. This is from Yahoo. So notice it has all of the information. So these are AAPL, that's the Apple stock, Starbucks, Nike. So these are different stocks. You could just add them on there and look at them and see what happens with them. This is all that information: opening, high, low, closing. There's a 52-week high, 52-week low, PE ratio. So it has all the same information that we just looked at, just in a different format. All right, so how do they calculate the current yield on a stock? So current yield wrong ones, is the annual dividend, sorry about that, per share dividing by the closing price per share. And then we have to convert it to a percent by multiplying by 100. I don't know why the formula always puts it times 100%. It's times 100 to give you a percentage, because 100% would just be 1, right? So for example, find the current yield of AT&T stock that reported a dividend of $1.68. So that's going to go up here. And a closing price of $26.28. So we got that information. Here's the $26.28. And then the dividend, DIV, is over here. 168. So if you divide those and multiply by 100, you get 0.064 times 100, which is 6.4%. And if you look back at that table, we have our 6.2. What is going on with this? You have your 6.2%. Sorry. 6.4%. I circled the wrong one. The yield. We were calculating the yield. All right, so that's how they calculate column 13, is just by taking column 12 and dividing it by column 6. All right, so how do they calculate and distribute dividends? So the board of directors votes, and remember, if you're a common stockholder, you get to vote as well, to reinvest any profits into the business or declare a dividend with some or all of the profits. So they don't have to declare the dividends. They could just reinvest the profit. And then a dividend can be expressed as a percentage of the par value. Remember, that's the face value of the shares, or as a dollar amount per share. And usually they're declared quarterly, so about 4 times a year. So these are the 3 different types of preferred stock. The participating is where stockholders receive additional dividends if the company does well. Convertible, that means that the stockholder can exchange the stock for a certain number of shares of common stock. So notice they have preferred, and maybe they want some common stock as well, so they share some of it. And then cumulative, they earn dividends every year. All right, dividends and arrears. We're going to be taking a look at this. So think of rear as like the back, so like back payments. So it's dividends that were not paid in a previous year. So maybe they decided to reinvest the profits and they didn't pay out dividends. But they have to be paid to the cumulative preferred stockholders, because remember, they earn dividends every year. So they're guaranteed dividends. So you have to pay them to the cumulative preferred stockholders before they can be distributed to other stockholders. So the first thing you're going to do is you're going to pay dividends and arrears. So you're going to pay back what should have been paid. So multiply the number of shares held by preferred stockholders, expressed as dollars per share. Okay, and then we'll take those away and say, okay, now what are we left with to pay the rest? So then you're going to pay the present year's preferred stock dividend. So we paid last year's, that's what this one is saying, to preferred. And then we'll pay this year's to preferred. And then whatever's left over we'll pay to the common stockholders. All right, so let's say you own a cupcake company. That's dangerous. Oh my gosh, don't those look good? You've issued 20,000 shares of cumulative preferred stock that will earn dividends at 60 cents per share and 100,000 shares of common stock. So we're going to have to divide this up. Last year you didn't pay any dividends. This year, $250,000 is available for dividends. So those need to be distributed. How are they distributed? So first thing I need to do is to pay back the preferred stockholders from last year, so paid dividends in arrears. So first, I'll pay $20,000 for the preferred stockholders, and they got 60 cents per share. So it's times 60 cents. Oops. I'll write it here. So that's going to be $12,000 that goes for the dividends in arrears. Okay, so now that that's gone, I need to take that away from the $250,000. So I'm left with $238,000. Now I'm going to pay the preferred stockholders for this year. So they still have the $20,000 times 60 cents for this year. So that's $12,000 again. So I'm going to subtract that, and that'll be dispersed based on how many shares each person invested. So the $12,000 gets split by the number of shares that they bought. So they'll get 60 cents for every share, but total it's $12,000. It's going to all the preferred stockholders. Okay, so we'll subtract that from the total. So now I'm left with $226,000. Now, the dividends and arrears have been paid, the preferred stockholders have been paid, so now the rest of the money can be paid to the common stockholders. And there were 100,000 shares of common stock, so I will take this and divide it by 100,000. So it's 2.6. So $2.60 for each common stock. So here's another way to look at it. Oh, sorry, I wrote the wrong number here. 226. I don't know what our problem is today. Okay, so $2.26 per share is going to each person. So we're giving $12,000 to last year's preferred stockholders, and then $12,000 again for this year. So basically, you'll take whatever you got in number one and double it for the preferred stockholders. And then you can subtract that off from the $250,000. We're left with $226,000 dispersed evenly among the 100,000 shares, and we get $2.26 per share. So total, preferred stockholders are getting $24,000 combined. That's the $12,000 plus the $12,000. And common stockholders are getting $2.26 for each share that they own. Okay, so another one. There are 10,000 shares of cumulative preferred stock that will earn dividends of 80 cents per share and 50,000 shares of common stock. Last year they paid no dividends. Now, if they did pay dividends last year, you don't have to do the dividends in arrears. You just do this year's. This year, $100,000 is available for dividends. So we're going to start off with the 10,000 shares at 80 cents each. So that gives us $8,000. It's going to the preferred for last year. And then, so that's last year. And then preferred for this year is going to be the same exact amount. And then for common, so here I have a total of $16,000. So I need to take that away from the $100,000 to see what I have left to give to the common stockholders. That gives me $84,000. And that's going to be divided by the number of common stocks. So there are 50,000 shares of common stock. If I divide that by 50,000, oops, I get $1.68 per share. So preferred stockholders get $16,000 total, and that's divided up evenly. Common stockholders get $84,000, which is $1.68 per share. Isn't this a great name for a company, by the way? All right, so that's it for stocks. For bonds, see what I did there? Bonds, saving bonds. Why would the government need to borrow money? Well, they pay people that work for the government, military, people who are retired, so that's Social Security, other people who need help, maybe on welfare. They pay for buildings, equipment, military bases, things that the government owns. So in order to get money, that's where bonds come in. They basically borrow money through bonds. And then also, obviously, through your taxes. So a bond is just a piece of paper that shows a person has agreed to loan money to the U.S. government, and then the government uses that money to help pay its bills. So it looks like this, and you may or may not have seen one before. Okay, the bond market is just like the stock market, where it's just the place where you buy and sell bonds, where you trade. Face value, again, is the same as par value, and the original value of a bond is usually about $1,000. Maturity date is when the face value of the bond is going to be paid to the bondholder. So if the maturity date is May 21st, then that's when the face value is going to be paid. Okay, so here are some different kinds of bonds. You may have seen these words before. Junk bonds are high risk. Some other ones that you may have seen as well. Okay. So a bond has a face value, a date of repayment, and a fixed rate of interest. So it doesn't go up and down. Like stocks, bond price, the prices fluctuate, the rate does not. Because a bond obligates the company to pay it in the future because of that maturity date, public judgment of the company's future will affect the sales of the bond. So how we view that company is going to affect whether or not we choose to kind of invest in them, right? So they're going to look closely at that interest rate and how much interest will be paid. Here's an example of a bond listing. So just like stocks, you've got 1 and 2 are the name and the symbol. The symbol's a little different. It usually has a dot in there. Column 3 is the annual interest rate. So the coupon is the interest rate as a percent, so 8.5%. Column 4 is the maturity date, and it will just tell you the month and the year. Column 5, it's different ratings from, there are multiple rating services, but these are the 3 primary ones. There's the Moody's rating, the S&P, and the Fitch. And so each of these has a different classification, but you could look up online what those mean, and it'll help you decide which ones to invest in. Okay, 6 and 7 and 8, you've got your high value for the day, low value for the day, and then this is also known as the closing price. It's the last value of the day. And this is listed as a percent of the face value. Okay, we've got our change. So if it went up or down from the previous day, positive went up, negative went down. And then the last column is the yield to maturity, so it's the annual rate of return. So not the interest rate, it's the annual rate of return over the life of the bond. And that's usually the column you want to look at because it's the best way to kind of measure the return. So if you look, the annual rate of return is highest for this one, so maybe I would want to invest in Citigroup instead of the others. Okay, so what's the interest rate and date of maturity for BAC.ICB? Okay, so that's Bank of America. The interest rate would be 7.625%. The date of maturity would be June 2019. The rating by Fitch, well, if you notice, Fitch is the third one. So you're going to look at the third rating, which is A+. Yay! 100%. Okay, what are the change and yield percent for this bond issue? So you're going to look in 9 and 10, we've got change and yield percent. So in column 9, it's 0.283, so that means it went up 0.283 from the previous day. And then the annual rate of return is 5.786%, which is one of the higher ones here. Okay, to calculate the price of the bond. So first you're going to find the percent of 1,000 that the bond was selling at for the close of the day. So that's this one. And then you're going to multiply that by 1,000 because it was the percent of 1,000. So to calculate the closing price here, we're going to take the closing price is listed as a percent. So right here, this is not $117. It's and notice it's 3 decimal places anyway. So usually with dollars, we only go to 2 decimal places. So this is the closing price as a percent of the face value. So we'll take that, we'll convert that to a decimal. So you'll move it over twice. And then you'll multiply that by $1,000. Because if you look at the last slide, it's the percent of 1,000. So it's $1,177.33. And a little shortcut. So what you're going to be doing is you're going to be taking this number, and first you're going to be multiplying it by 100, dividing it by 100, and then you're going to be multiplying it by 1,000. So really, it's like you just multiplied by 10. So if you just take this and move the decimal over once, so what it originally was, if you just move that over once, you'll get the answer. And that works every time. So that's kind of the shortcut. To find the closing price, just take column 8, the last price of the day, so think of closing as being the last, and then just move the decimal over once. Little joke for you. Okay, bond key terms. See? So yield is the measure of the profitability of the investment. Yield to maturity is the profitability over the whole life of the investment. The current bond yield, or average bond yield, is the annual interest per bond to the current price per bond. So to calculate the current bond yield, first you'll calculate the current price of a bond. So that's like what we did. We did closing price there, so it's like that. And then you'll locate the stated interest rate, which is from column 3. And you'll multiply that by 1,000, because that's usually the face value of the bond. Now, sometimes it might be different, but typically, as mentioned before, the face value of the bond is 1,000. So you're always multiplying by 1,000 in these problems. And then you're going to take, to find the current yield, you'll take the stated interest rate and multiply it by 1,000. Then you'll divide by the current price of the bond, and then times 100 to change it to a percent, because the current yield is a percent. So, if we look at Kraft Foods, KFT.GX, let's calculate the current bond yield. Okay, so there's our percent. It's 5.375%. And we're going to take that, so here's our formula. Take the stated interest rate times 1,000 and divide by the current price. So you'll multiply this as a decimal, so 0.05375, because you can't Just put a percent into the equation until you've converted it. You can't use it. Then multiply by 1,000. And then we divide by this current price, also known as the closing price. And remember to calculate the closing price. That's where we just take this and move the decimal over once. So that's where we get the 1,034.11. Okay, and then just multiply it by 100. So it's 5.198%. So that is the current yield. All right, so that's it for bonds. For mutual funds, so that's where they pool your money with other investors, and then they put in what's called a portfolio. So you want to have a fund manager who manages your portfolio, which contains your stocks and bonds and all of the diverse companies that you've invested in. And the advantage is that it diversifies your money. So if one company tanks, you don't lose as much money, as mentioned before. The disadvantage is because it's not as risky, you probably won't earn as much as if you invested in a stock that did really well. Okay, one word you might want to know, or one phrase, I guess, net asset value. So it's typically called the NAV. This is the value of one share of the fund. And it goes up and down just like the stocks and bonds go up and down. I got a little joke for you there. Okay, so here's what a mutual fund listing may look like. So these are the fund families. Sounds like I'm saying fun family. It's a fun family. So this, within this family, you have multiple things going on here. You have multiple stocks and bonds. So these would be the specific fund names. So these are the funds. This is the family. And then the symbol, notice there's no dot like there was in bonds. And it's a little longer typically. Okay, and then in column 3 you have the net asset value. So 1025. So remember that is, if you look back at your definitions, it's the value of one share of the fund. So how much it's worth per share. And then in column 4, that's the change. So in one day, since it's positive, it's gone up 8 cents from the previous day. All right. Column 5 is the year to date. So that's what YTD stands for, year to date percent return. So it's gone up 6.2% from the beginning of the year. And then this is probably the most important column that people will look at. Oops. The 3-year change. Because typically mutual funds are long-term investments. So if you want to see what's happened over long term, in the last 3 years, this has gone up 4%. This one's gone down 14.3%. So clearly that one wouldn't be a good one to invest in, because over the last 3 years it's gone down 14.3%. Even though it's gone up 0.1% in the last year, that's not really significant. Overall it's gone down, so maybe not one to invest in. Okay, so the current price per share of AFMMX. Okay, so that's this one. What was the price per share yesterday? All right, well, you have to think about the change. It changed 9 cents from yesterday, right? And today, the NAV, the current price per share, is $10.98. So if it's $10.98 now, and it's 9 cents higher than it was yesterday, then I'm just going to subtract this $10.98 minus the 9 cents. So yesterday it was $10.89. Oops. So because if yesterday it went up, that means yesterday it had to have been lower than it was today. So that's why I subtracted. So $10.89 was yesterday's. Okay, how to find the NAV? at the beginning of the year. Okay, so you take the current NAV and you divide it by basically the percentage that it's changed. So it's 100% plus whatever the year-to-date percent is. So if it's gone up 4%, that means it's 104% of what it was before. So that's why we're adding it to 100. If it's gone up 10%, that means it is now 110% higher than it was. So you have to add the percent to 100, and then you'll divide the current NAV by that. So, for IICAX, let's be on the next one. Oh, here it is. Okay, so right here, you're going to take the current NAV, which is 816, and you're going to divide it by the percent that it's changed. So it's changed 7.5%. So this is 100% plus 7.5%. So that's 107.5%, but we never leave it as a percent if we're going to do a calculation with it. So I need to convert it to a decimal by moving it over twice, and that's where I get the 1.075. If I divide that, I get 759 was the beginning of the year. So it's improved, right? 7.5% in fact. Okay, to calculate the return on investment, you calculate the gain or loss. So it could have increased or decreased, right? By subtracting the total cost from the proceeds, including any additions from dividends. So if you made money or if you earned interest, you're going to subtract all that stuff. All right, the return on investment is found by dividing the total gain or loss by the total cost. So we want to calculate ROI is just the abbreviation for return on investment. For 1,000 shares of a mutual fund purchased at a price of $8.16, so this is like the last one we did, sold with an NAV of $9.36 that paid a dividend of 27 cents per share. Okay, so you made $8.16 for each share, and you had invested 1,000 shares in 1,000 shares. So, I'm sorry, this is how much you purchased it for. So you pay, wrong one. So you purchased it at $8.16 per share, but you sold it for $9.36 per share. So what you made was $9.36 for each share. So first we're going to figure out how much we made. 1,000 shares times $9.36. So we made $9,360. Okay, but we had purchased them at $8.16. So we are going to eventually subtract that, but we also are going to have to take into account our dividends. So let's go ahead and do that. It paid a dividend of 27 cents per share. So I earned 27 cents for every share in addition to that, right? So I'm going to take 27 cents times the number of shares, which was 1,000, and that's $270 that I earned in dividends. Okay, and then it cost me $1,000, or 1,000 shares were $8.16 per share. So I'm going to do 1,000 times $8.16, which is $81.60. So then I will add in the additions. So this is all money that I made. So I'll add those together, and then I'm going to subtract what it cost me. So overall, I ended up making $1,470. So that's my return on investment. So that's what I made from my investment. Now, if I want the return on investment rate, which is usually what they're asking for, even if they don't come out and say it, they're wanting the rate. Then you'll take your gain or your loss, which in this case, it was a gain, right, because it's positive, of $1,470. And I'll divide that by the original cost, so what I originally purchased them for. So it's going to be 1,470 divided by 81.60. That was my original purchase. That gives me 0.18, but I want that as a percent. So I'm going to move the decimal over twice to give me 18.01%. Okay, so just a couple of things to look at if you're thinking of investing. Some questions to ask yourself. So if you want to know, like for example, does it pay interest? Okay, your piggy bank, no, you're not going to get any interest from just keeping it in a piggy bank, right? Savings account, yes. Typically it's not high, but you will earn some interest. Individual bonds, yes. Mutual funds, maybe, depending if you make money. Same with stocks. Real estate, no, you're not going to get interest on that. Collectibles, no. Precious metals. So these are different, all these different things you could invest in. Is it best for long-term or short-term goals? So something to consider if you're just wanting to invest it and make some money kind of quick. Maybe these, or these will get you through for now, but long-term you really should start looking at investing in stocks and mutual funds and real estate if you can afford that, things like that. Okay. Can someone steal it? Okay. These cannot be stolen. Yes, I can talk. These ones can, like if it's in your piggy bank, yeah, someone can break in and steal your money, right? But they can't steal your investments. Do you need a minimum amount of money? Okay, no. You might, depending on the savings account, right? Individual bonds, yes, usually face value is $1,000. Mutual funds, yeah, you're going to need to invest some money. We can't just say, I'll take a mutual fund for $0. No, you have to invest some money in these. Okay. All right, and that concludes our stock, bonds, and mutual funds conversation. As always, let me know if you have any questions. And if you have any expertise in stocks, bonds, mutual funds, I know there are some people who have been in finance. We would love to hear any insights you have or any tips you have for investing. We welcome that. You can just put that on the canvas in the discussion board. Thank you very much.